Silver markets are reeling as prices hover around $76.10 per ounce, down from recent peaks but still reflecting extraordinary gains. The precious metal has surged more than 150% in 2025, and physical silver in Shanghai is trading above $80 per ounce, while COMEX futures remain in the $30–$35 range, exposing a massive disconnect between paper and physical markets that has sent shockwaves through Wall Street's trading desks. On January 1, 2026, China implemented sweeping export restrictions that have fundamentally altered the global silver supply chain. The new licensing framework, which effectively restricts 60–70% of the global silver supply to domestic use, requires exporters to demonstrate annual production exceeding 80 tons and maintain consistent export records from 2022–2024. Only 44 companies received approval to export silver under the new 2-year licensing regime. The move represents far more than regulatory tightening. Silver has become China's new industrial leverage, joining rare earths as a strategic weapon in the escalating economic rivalry with the United States. The timing is no accident. As Tesla CEO Elon Musk warned on social media, this is not good. Silver is needed in many industrial processes, highlighting the critical role the metal plays in everything from semiconductors to solar panels. The export restrictions have accelerated an already dire supply situation. COMEX registered inventories in the United States are down nearly 70% since 2020, while London Bullion Market Association vaults have lost around 40% of their holdings. In Shanghai, exchange stocks fell to their lowest levels since 2015. The scarcity is creating unprecedented pricing dynamics. Canadian buyer Kuya Silver reported receiving offers from Chinese companies to buy physical silver at around $8 above market prices, while an Indian buyer offered $10 above market rates. This desperation for physical metal reveals the true depth of the supply crisis facing industrial users worldwide. At current consumption rates, some industrial regions have barely 30 to 45 days of accessible silver reserves, a situation that threatens to disrupt production across multiple high-tech sectors, including solar energy, electric vehicles, and advanced electronics. Behind closed doors, major U.S. financial institutions are scrambling to manage their exposure to silver markets. The CME Group implemented an unprecedented $25,000 margin hike in late December, forcing mass liquidation of retail positions in what some analysts describe as a deliberate intervention to allow deeply short bullion banks time to cover positions before physical shortages intensified. Social media has erupted with speculation about the scale of institutional short positions. Posts viewed by over 1 million users suggest Bank of America is short 1 billion ounces of silver, and Citigroup is short 3.4 billion ounces, figures that would represent multiple years of global production if accurate. While these claims remain unverified and banking executives have shown no public signs of distress, the rumors underscore growing anxiety about derivative exposure in a market experiencing unprecedented physical tightness. Institutional investors and major banks are quietly converting paper ETF holdings into allocated physical positions, securing delivery before liquidity disappears. This strategic shift suggests sophisticated market participants recognize that the traditional paper market may no longer reflect physical reality. Silver's current crisis stems from structural imbalances that have been building for years. 2025 marked the 5th successive year of silver deficits, with demand reaching 1.17 billion ounces, while mine supply totaled only 835 million ounces. The cumulative deficit from 2021–2025 approaches 820 million ounces, roughly equivalent to an entire year of global production. Unlike many commodities, silver cannot respond quickly to price signals. Approximately 75 to 80% of silver comes as a mining byproduct of copper, zinc, and lead operations, meaning that even dramatic price increases won't significantly boost production. Primary silver mines face their own challenges, with ore grades declining at many mature operations and closures across major producers in Mexico, India, Russia, Bolivia, Kazakhstan, and Peru. While supply struggles, demand continues its relentless climb. The IEA forecasts solar capacity will quadruple by 2030, with each solar panel requiring significant quantities of silver for its photovoltaic cells. The automotive sector adds another demand vector, as battery electric vehicles consume on average 67 to 79% more silver than internal combustion engines. Advanced technologies from artificial intelligence hardware to 5G infrastructure all depend on silver's unique properties. The semiconductor sector is particularly exposed, as silver pastes are critical for bonding processes in advanced chip architectures, with supply chain diversification requiring 12–24 months of qualification timelines. The United States government has taken notice. In 2025, the U.S. added silver to its critical minerals list, acknowledging that the metal is strategically essential to clean energy systems and high-tech manufacturing, placing it on par with rare earths and battery metals. With physical shortages intensifying and China's export controls now in full effect, analysts are dramatically revising their price forecasts. Citigroup predicts silver could reach the high 70s in 2026, while more aggressive forecasters see a path to $100 per ounce. Several analysts predict silver reaching $100 or higher in 2026, with some suggesting that China's export restrictions could serve as the supply shock that triggers even more extreme price movements. The convergence of structural deficits, geopolitical tensions, and monetary debasement creates conditions unlike anything the silver market has experienced in decades. As of early January 2026, spot silver trades around 74-75 Oz on COMEX, while Shanghai prices remain at 78-80 Oz equivalents, reflecting a persistent 5 to 8 Oz premium. This decoupling between Western and Eastern markets signals that the traditional price discovery mechanism may be breaking down. The silver market stands at an inflection point. China's export controls have transformed what was already a stressed market into a full-blown crisis, with physical silver premiums signaling that buyers are desperate for actual delivery rather than paper exposure. The days of treating silver as just another commodity may be ending. For industrial users, the message is clear: secure physical supply now or face production disruptions. For banks holding large short positions, the squeeze is tightening. For investors, silver's dual nature as both an industrial metal and monetary asset suggests the rally may have further to run. Once physical delivery becomes the benchmark for price discovery, traditional futures exchanges like COMEX may lose control of global pricing altogether. Similar to what happened in lithium and rare earth markets when physical shortages emerged, the world is waking up to a metal that has been underestimated for decades, and the repricing has only just begun.